Now let's get another view from a man who advises clients with a combined £170 billion to invest. Robert Gardner is co-founder and CEO of investment consultancy Redington, and he joins us now. Rob, thank you so much for joining us in the studio. In terms of what we're seeing, of course, the market rout has had a crucial impact on a lot of the pension funds. So what do you tell your clients to actually try and match up for the losses that they've made? Is there any product that looks attractive at the moment as a kind of, hedge against possible more volatility on the market?
Well, good morning. Let's just unwind a little bit. Unfortunately, our clients are faced with the triumvirate of political, economic and financial uncertainty, like all investors.
Any investor.
Now, hopefully, 3 years ago, there were a lot of lessons learned from the 2008 financial crisis, and many have since adopted a much more robust risk management framework. If you have that in place, they have tended to fare the funding volatility a lot better than those that haven't.
Just because they're more diversified?
Because they're more diversified, they're taking smaller bets in more areas. The key opportunity that has come out of this crisis is real hard assets, real estate and infrastructure that throw off long-dated inflation-linked cash flows.
But of course, these means that they have a smaller yield. So what would your advice be? Buy 20% of the higher yielding but kind of more secure longer-term investment and the rest in high risk, or 10% high risk? I mean, how do you break up your portfolio?
Actually, the key is actually to go for more of the stuff in the middle. So the approach before has either very low-yielding monetary assets, gilts and cash, or very high-yielding equities, emerging market equities, private equity. There's a whole gap in between which gives you real returns of 3 to 5%. And it's actually increasing the portfolio in that middle part that makes a lot more sense.
And so can we call these more tangible assets? And would these be only in the UK or also the rest of Europe?
The assets are global, but it makes most sense to have UK assets for UK pension funds. So you want a UK water company for a UK pension fund, you want a Canadian railway for a Canadian pension fund, and Australian hospitals for Australian pension funds.
And do you know how much, of course, these would be much less volatile, I imagine. How much of a return would you expect from these more tangible assets?
The key to reducing the volatility is to take out the gearing. So when I'm talking about buying these hard assets, it's buying them in an unleveraged format, which is not the way these assets were financed 3 years ago. If you do that, depending on whether you're coming in at the development stage or buying a secondary asset, the real returns are between 5 to 6 pre-development or between 3 to 5 post-development.
And so do you have any advice for just, the guy down the street who's worried about his pension and says, well, I don't know whether I need to opt out of the government pension scheme or the private pension scheme, or what are the signs that a pension is actually doing all it can to protect your investment? Would it be investing in these, more hardware assets?
For the guy on the street, if they're under 30, my top tip would be to start contributing now. The younger you start contributing, it has an overwhelming impact on the size of your pot at retirement.
Even with this volatility on the market?
Even with this volatility,
you'd be scared, wouldn't you?
Even with this volatility, the best thing you can do if you're under 30 is to keep contributing into your pension scheme. As you get older and 40, 50, then you do need to think a lot more about your investments. And going for real return assets with less volatility and more income generation is definitely the way forward.
Because it basically hedges, but you still want to keep some of the equities, so some of the indexes actually linked to the higher yielding assets.
Yeah, like everything in life, you want a series of risk and return
baskets,
profiles.
Of course.
Not 80, 90, 100% in equities, which has been the traditional approach.
What about commodities? Because I actually have people sitting in your seat, and half of them say it's a great time to buy because gold is going to go to 2,000. It's still going to be a great hedge against inflation. Others saying, that's it, it's overdone. This is an asset bubble just waiting to burst.
Yeah, commodities is a difficult one. I mean, again, if you can afford to put an allocation 2 to 5% into commodities as part of your overall portfolio, it makes a lot of sense.
All right, Rob, great to have you in the studio. Rob Gardner there.